Hello, everybody. Welcome to the fifth episode of Prelims Economic Basics. Today's topic, what we are going to discuss, will be bonds. Now, what are bonds basically? So, bonds are basically issued by government or corporate bodies, and they are issued by government for what purpose? Government or corporate bodies basically to borrow money. Clear? And as far as a normal individual is concerned, why will they invest on these? Because they are investment instruments. It will give you assured return. Clear? So that is the reason why you have bonds. Bonds for government or corporate bodies is basically what? An instrument to borrow money for an average Indian citizen or a high net worth individual. Why would they actually what buy such bonds? Because it is a investment instrument. Now, when you buy a bond or an investment instrument, basically what happens is you get an assured rate of interest as return. Now, the working of a bond, how does it function, etc. Right now, from a prelims perspective, it is not part of our discussion. But what you need to understand here is when the interest rate of banks is less, demand for bonds will go up, price of bonds will increase, the yield of bond will come down. The reverse scenario, if interest rate goes up, demand of bond will decrease, price of bond will decrease, yield will go up. Reason being, when interest rate is low, there is no point in putting your money in FD. Instead, that same money you can put in what? In bonds, which will give you a better rate of interest. Whereas when interest rate is high, FD will give you better rate of interest compared to what? Compared to bond. Therefore, demand for bond will come down, price of bond will come down, and yield will increase. Or in other words, price of bond is inversely proportional to the yield. This is the first thing that you need to understand. Just continuing the discussion here again. Therefore, a bond holder will face capital loss during inflation. That is, if I have invested on a bond and if I'm holding on to a bond during inflation, when where the interest rate will be high. In such a scenario, interest rate of bank is high. Therefore, if I'm holding on to a bond, there is a good chance that I will face capital loss because rather than holding on to the bond, it is better if I park my money in bank. Clear, people? Coming to operation twist of RBI. This is again one of the quantitative tools of RBI which was introduced basically to deal with what? Inflation. So let us see how does this work. Operation twist. So operation twist, what it means is the simultaneous buying and selling of securities. Which securities are bought? Long-term securities. Which securities are sold? Short-term securities. Now, when RBI is ready to buy the long-term securities, what will happen to the demand for long-term securities? It will be very high. Therefore, price will be very high. Therefore, yield will be less. So, in other words, when people will invest more and more on bonds, okay, people are going on buying bonds, but nobody wants to what? Take loan from the bank. In that scenario, what will banks have to do? Banks will have to lower their interest rate for long-term loans. Clear, people? Now, on the other side, what about selling short term? When you sell short term, what happens is for short term bonds, the yield will increase. And because of that, what will happen? Interest rate for short term loans will also increase. Therefore, at short term, it will help in what? Controlling the inflation. Clear, people? This is the idea. So, buying and selling of simultaneous securities, the purpose is what? When you buy long term bonds, what happens is interest for long term loans will be less. Therefore, growth will not be compromised. Growth will continue. On the other hand, when for short-term loans, the interest rate picks up. What happens? It will help in controlling inflation. Clear? Bonds are of basically at a basic level. What types of bonds are there? You have GSEC, which is government security, which can be issued by center and state. You have treasury bills, which is only issued by the center, for which no interest is paid. And it is basically issued for 91 days, 182 days, or 364 days. Then you have cash management bill, which is issued again only by the center, behaves just like your T-bill only, with only difference that it has a tenure of less than 91 days. Then you have dated G securities where you have both center and state issuing them, and it is up to 40 years tenure is there. Clear? Now, from the survey, let us learn a few concepts here. First one is weighted average lending rate. Weighted average lending rate is the total interest divided by the outstanding loan. Clear? So total interest that you are earning, total interest earned divided by outstanding loan. So if WALR is high, it means your profit is high as well as your risk is high. Why? You have given too much of loan, that is why you are getting too much of interest. If weighted average lending rate is less, then your profit is less, your risk is also less. Next, marginal cost of lending rate. Marginal cost of lending rate simply means it is the lowest rate below which banks are not allowed to lend, which is based on the cost of funds, profit of the bank, administrative cost of the bank, and the statutory reserves that the bank is supposed to keep. Marginal cost of lending rate is linked to the policy rate. That means what? If repo rate, what is the policy rate? The repo rate. If repo rate increases, MCLR will increase. If repo rate decreases, MCLR will decrease. Then you have provision coverage ratio. What do you mean by that? Provision coverage ratio means the total provisions that you have kept aside as a percentage of your non-performing loans. Clear? Greater is the PCR means what? Greater PCR means what? Greater provisions you have kept aside for your non-performing loan, which means the financial health of the bank is good. Then you have capital adequacy ratio or capital to risk-weighted assets ratio. What does that mean? The total capital of the bank divided by the risk-weighted assets. What do you mean by risk-weighted assets now? See, you must understand here, for personal loan, generally, the risk for a bank is less. Why? Why? Because salaried class people will pay back the EMIs, everything on time. On the contrary, when you talk about agricultural loan, industrial loan, service sector loan, the risk factor is high because at any time, anything bad can go wrong. So you will assign risk for each of these loans. Higher risk for those loans which can become default, lower risk for those loans like the personal loan, which where the chances of becoming default is less. Once you assign the risk and the loan amount, you multiply them together and finally you add it up. That is your risk weighted assets. Capital to risk weighted assets simply means how much money are you having for all the loans that you have given? How much capital, percentage of capital have you set aside to protect yourself in the event any one of your assets becomes non-performing? Provision coverage ratio means already the bank is having a few loans which have become non-performing. For that, you are keeping aside a certain amount of money, provision. So if a bank is already having 100 crore worth of non-performing assets, you are keeping what? 30 crore aside. You are keeping a provision there. For what? Just in case if that 100 crore, you lose it out completely. So you will still have 30 crore to absorb the shock. You need to only worry about how to arrange the other 70 crore. In the case of capital to risk-weighted assets, your assets are still performing. None of the assets have become what? Non-performing yet. They are all performing. Interest payment or principal payment you are getting. So you need not worry. But still you are keeping a certain set of capital aside in case any one of the assets becomes what? Non-performing. Clear, people? This is the idea. Hope you understood the episode number 5. Only very few portions are remaining from banking. After that, we'll be starting off with fiscal policy. Any suggestions you have, please put it up in the comment section. God bless. Take care.